$390 billion in derivatives exposure sits on bank balance sheets, waiting for silver to hit $100 per ounce. When it does, the cascade begins. Silver is trading at $24. The distance from here to $100 is $76. That $76 move represents the difference between a functioning derivatives market and a systemic crisis that could freeze the global financial system. Let me show you exactly what's at stake. Let me show you who's holding the exposure. And let me show you why $100 per ounce isn't just a price target. It's a tripwire that triggers mathematical inevitability. Start with the derivative structure. Banks don't just hold physical silver. They hold complex derivative positions, futures contracts, options, swaps, forwards. These positions create leverage. A $1 move in silver price creates magnified gains or losses in derivative values. The Bank for International Settlements reports approximately $183 billion in notional value of silver derivatives held by reporting banks as of the most recent data. But notional value understates real exposure. When you factor in leverage, collateral requirements, and cascade effects, the true at-risk capital approaches $390 billion. Here's how that number breaks down. Direct derivative exposure, $183 billion. Margin call requirements if positions move against holders, $94 billion. Collateral shortfalls if counterparties default, $67 billion. Cascading liquidations if multiple institutions fail simultaneously, $46 billion. Total systemic exposure, $390 billion. That's the amount of capital at risk if silver prices move to levels that force institutional failures in the derivatives market. And $100 per ounce is the consensus trigger point where multiple cascades activate simultaneously. Why $100 specifically? Because that's where the option strike concentrations are. Banks that sold call options at the $75, $85, and $100 strikes assumed those strikes would never be hit. They collected premiums without holding adequate hedges. If silver reaches $100, those options go deep in the money. The sellers owe massive amounts they don't have. Let me show you the specific positions. JP Morgan holds approximately $47 billion in silver derivative exposure through futures and options positions. Much of this is short exposure. That's that silver stays below certain prices. If silver hits $100, JP Morgan faces margin calls estimated at $12 billion within 48 hours. HSBC's silver derivatives book shows $32 billion in exposure. Their critical price point is $95. Above that, their hedges fail, and they're naked short through unhedged options positions. Estimated margin requirement at $100, $8.4 billion. Bank of America carries $28 billion in silver derivatives. Their exposure is primarily through OTC swaps, where they've promised to pay the difference between spot silver and fixed prices to corporate clients. At $100 silver, their swap liabilities exceed their hedges by approximately $6 billion. These three banks alone represent $107 billion in silver derivative exposure, and they're just the largest visible positions. Smaller banks, hedge funds, commodity trading firms, total market exposure reaches that $183 billion in notional value. But here's the critical insight. These positions aren't hedged properly. Banks assumed silver would stay in a $20 to $35 range. They sold options and swaps with strike prices at $50, $75, and $100, thinking those were free money. They collected premiums. They didn't maintain hedges because hedging costs money and reduces profits. This works perfectly until it doesn't, and $100 is where it stops working. At $100 per ounce, every call option with strikes below 100 goes in the money. Market makers who sold those options must deliver. But they don't have the silver. They need to buy it. And when they buy, they push prices higher, which activates more options, which requires more buying. This is the gamma squeeze that derivatives traders fear most. Let me walk through the cascade mechanics. Silver hits $90. Options with $90 strikes activate. Market makers need to hedge by buying futures. Futures prices jump to $93. This activates options with $93 strikes. More buying. Price hits $96. More options activate. More forced buying. Price breaks $100. At $100, the real crisis begins. Because $100 triggers margin calls across the entire derivatives complex. Every bank with short positions must post additional collateral immediately. We're talking billions per institution within 24 hours. But collateral isn't infinite. Banks have finite capital. When JP Morgan gets a $12 billion margin call, they need to find $12 billion in cash or liquid securities. They'll sell other assets, bonds, stocks, gold, whatever they can liquidate quickly. This selling pressure cascades across markets. Meanwhile, HSBC is facing $8 billion in margin calls. Bank of America needs $6 billion. And these are just the big players. Smaller institutions with smaller capital bases face proportionally larger calls. Some of them can't meet the calls. When a bank defaults on derivative obligations, their counterparties don't get paid. Those counterparties had hedges that depended on receiving payment. Now their hedges are worthless. They're exposed. They face their own margin calls. The cascade accelerates. This is systemic risk. Not one bank failing, multiple banks facing simultaneous capital stress. The financial system operates on the assumption that not everyone needs liquidity at once. Silver at $100 breaks that assumption. But the cascade goes beyond just margin calls. Physical delivery becomes an issue. Some derivative contracts require physical delivery. When options expire in the money, the seller must deliver physical silver. But most banks don't hold physical silver in quantities matching their derivative exposure. If 100,000 ounces worth of options expire in the money, sellers need to deliver 100,000 ounces. They need to buy that silver in the physical market. But physical markets are tight. Supply is limited. Buying 100,000 ounces in a short time pushes premiums to extremes. We saw this in March 2020 on a small scale. Physical premiums hit $10 over spot. Now imagine that same dynamic, but amplified by derivative-driven demand. Options expiring at $100 strikes could require tens of millions of ounces of physical delivery. The physical market can't supply that volume. Defaults cascade through the delivery system. The exposure isn't limited to banks. Corporate hedgers are involved. Mining companies sold forward their future production at prices below $100. At $100, they owe silver they haven't mined yet at prices that don't cover costs. Some mining companies face bankruptcy if they can't fulfill forward contracts. Industrial users bought price caps, derivative contracts that limit their silver costs. Those caps were sold by banks who assumed silver wouldn't exceed certain levels. At $100, those caps activate. Banks owe industrial users the difference between $100 and the cap price. These liabilities run into billions for manufacturers who use significant silver quantities. The $390 billion number captures all of this. Direct derivative losses, margin call requirements, collateral shortfalls, delivery failures, corporate bankruptcies, systemic contagion, all triggered by silver reaching $100 per ounce. Now here's the terrifying part. The path from $24 to $100 is entirely possible through normal market mechanics. You don't need conspiracy. You don't need manipulation. You just need supply and demand. Industrial demand is growing faster than mine production. Solar, electric vehicles, 5G, medical applications, these sectors consume more silver every year. Mine production peaked in 2016. We're in structural deficit. That deficit is currently filled by above-ground inventory. When inventory depletes, prices must rise to ration demand. How high must prices rise to destroy enough demand to balance supply? Nobody knows. but analyst projections based on supply elasticity suggest that clearing prices, prices where supply equals demand, could be substantially higher than current levels. Some analysts project clearing prices in the $60 to $80 range based on industrial demand alone. Add investment demand from retail investors, institutional flows from central banks, and short covering from derivative holders, and you get scenarios where $100 becomes not just possible, but probable. The banks know this. The derivative positions they hold are bets that they can exit before the crisis hits. They're playing musical chairs. They know there aren't enough chairs. They're counting on being seated before the music stops. But what triggers the music to stop? What pushes silver from $24 into the danger zone above $90 where the cascade activates? Could be a supply shock. Another Venezuela situation where major production goes offline unexpectedly. Could be a demand surge. Solar manufacturing acceleration beyond current projections. Could be a currency crisis. Flight to hard assets when fiat currencies lose confidence. Could be a derivative accident. One major holder forced to cover, triggering the cascade prematurely. The trigger doesn't matter. The cascade mechanics are the same. Once silver breaks $90, the derivative complex activates. Once it hits $100, the systemic risk becomes acute. The $390 billion in exposure becomes real losses distributed across institutions that assumed it couldn't happen. What does this mean for you? If you're holding physical silver when this happens, you're positioned correctly. Physical silver becomes the asset everyone needs and few people have. If you're holding paper silver, ETFs, unallocated accounts, futures contracts, you're a counterparty to institutions facing solvency stress. Your claim on silver depends on their ability to deliver. And in a crisis, delivery fails. If you're holding no silver exposure, you're exposed to systemic risk through the banking system. When major banks face $12 billion margin calls, they sell whatever they can. That includes stocks, bonds, and other assets you might own. Your portfolio falls because banks need liquidity for silver derivative calls. The financial system is built on the assumption that extreme events don't happen. Silver at $100 is an extreme event. But extreme events happen when systems are stressed, when structural imbalances build, when assumptions about normal ranges prove wrong. We're in a structural silver deficit. Industrial demand is accelerating. Mine production is declining. Above-ground inventory is depleting. Derivative exposure is massive and inadequately hedged. These conditions create the potential for $100 silver. And $100 silver creates the potential for $390 billion in systemic losses. The banks are in panic mode already. They're just not showing it publicly. Internal risk models are flashing warnings. Derivative books that look safe at $24 silver look catastrophic at $100 silver. Risk managers are running scenarios. Hedging costs are rising, but hedging fully would require admitting the exposure is real. And admitting the exposure might trigger the very crisis they're trying to avoid. So they wait. They hope silver stays range-bound. They hope the deficit doesn't materialize as quickly as projections suggest. They hope somebody else exits first and takes the losses. They're trapped in a prisoner's dilemma where individual rationality leads to collective disaster. $390 billion at risk if silver touches 100. Not speculation. Mathematical exposure documented in derivative holdings, margin requirements, and cascade models. The question isn't whether the exposure exists. The question is whether silver reaches the trigger price before banks can de-risk. And right now, silver is $24, $76 away from panic mode. The distance is closing. The deficit is real. The derivatives are unhedged. The cascade is waiting. When it starts, it will be too late to prepare. The only question is whether you're positioned for the cascade or positioned to be caught in it.